Hello from Oanda Markets. This is Jeff Halley, Asia Pacific market analyst. We have a busy 48 hours ahead of us in the financial markets. Tech stocks have been gyrating aggressively this week on inflation fears. Will they, won't they, with bond movements in the yield curve moving up and down. And that is driving these sort of headless chicken chasing tail movements we're seeing in stock markets and in other asset classes, notably Forex markets, but also in precious metals, notably gold. Tonight we have the first of two long-term US bond auctions. It's a 10-year auction tonight. It's a 30-year auction tomorrow. Interspersed with that is US CPI. Now, any one of these three events could actually turn sentiment lower again in markets. If the bid to cover ratio becomes in very low for either of those two auctions, or if US CPI moves higher than the expected 1.7%, the inflation fears will rear their head again, and we're almost certainly going to see another sell-off in tech stocks with a rotation into cyclical industries that dominate the Dow Jones. If we look at our S&P chart, we can see that the S&P itself is very finely tuned at the moment and holding just above long-term support. It could go either way from here, but a break of that trend line that you can see will signal that quite a large down move is on the way. Meanwhile, on the Nasdaq, if you look at the chart, we can see that the Nasdaq actually broke out of its March 2020 uptrend a couple of weeks ago, and it's really consolidating below that line. And if we see a poor bond auction result over the next 24 or 48 hours, I believe that we can see the Nasdaq move much lower, possibly down towards 11,800. It's a similar picture on the Chinese CSI 300, a key index. And we look at the chart here, we can also see that that March 20 support line has been broken. The Chinese government has been actually actively intervening in the market over the last 2 days to try and slow that descent. But the CSI 300 is very, very delicately poised as well. A similar story is being seen in gold. Gold has fallen through its 50% Fibonacci level at around $1,760. Since then, it's never looked like recovering it. If we look at the chart now, we can see that it's tested at 61.8% Fibonacci at 1,680 or thereabouts. Now, a daily close below that level, if bond yields spike again, would signal a big drop down towards the $1,600 an ounce regions. The same picture is being played out in the currency markets, most notably in the commodity currencies, which have been the darlings of the market up until now, with a high beta to the stock market rally and the global recovery. The Canadian dollar, the dollar Canada pair is at the present line, at present times, testing its long-term trend line, which is around the 127 mark. Now, a close above that 127 mark signals from a technical basis that we are going to have at least another 300-point rally to around 1.3000. Ditto on Aussie, it has already broken out of its rising wedge, a multi-month rising wedge at 77.50, and it's now targeting 0.7200. Kiwi, New Zealand dollar, similar story, broken its multi-month support line at 72, and it could potentially fall towards 0.6800. Similar stories playing out on euro and sterling as well. So markets are very delicately poised. If we see a spike in yields again tonight or tomorrow night, we could well see more dollar strength across the board and more downward pressure on technology stocks in particular, and also on precious metals. Thanks very much.